It is an absolute honor to be asked to speak at this august occasion, following on the footsteps of great leaders of our society who addressed this event before me, some who are in government and esteemed business leaders who are active participants in our economy. I wish to extend my gratitude to the University of South Africa, the biggest university in our continent, for the invite, particularly to talk about Africa's financial and economic prospects. This, as you would know, is a fascinating topic and very exciting in today's world. Moreover, it has great significance for South Africa, a strong and growing Africa which can only be positive for South Africa, both in terms of economic growth and in terms of political security. A report on Africa's attractiveness to foreign investment was published by Ernst & Young, the global accounting and consulting firm, their second report on Africa. The report tells an interesting story. On the one hand, many large investors are doing very well on the continent. As they put it, I quote, "There is a new story about Africa, a story of growth, progress, potential, and profitability," close quotes. However, they say that perception gaps remains between investors already doing business in Africa and those who have not yet invested and continue to associate the continent with instability, conflict, and corruption. Let us have a closer look at what happened in Africa in the recent years and try to understand what is really going on. We should look at Africa since the year 2000, its performance, trade investment, and growth, including the Millennium Development Goals. We must also look at Africa before the financial crisis. Program Director, with your permission, let me go back a few years. Africa began to grow more strongly in the early to the mid-90s, 1990s, and many African indicators began to turn around. In 1990, Africa's real GDP measured in current US dollars was about 877 billion. By 2010, it had risen to 1679 billion. This is a compound average growth rate of about 5.1%, which is higher than any other region in the world except the emerging markets in Asia. To see what has happened, we need to break it down a bit further. In the 1980s, the average growth rate of Africa was 1.9%, slower than the population growth rate, and Africans were getting poorer. During the 1990s, the growth rate rose to an average of 2.3%, improving especially in the second half of the decade. From 2001 to 2006, Africa grew at an annual rate of 6%. And then after the financial crisis hit, the growth rate fell to about 4.7%. So even during the financial crisis, ironically, Africa's growth was resilient. At the London summit of the G20, a concern was expressed that poorest countries, many of which who are in Africa, would be most severely hit by the global financial crisis. This is partly due to the effective measures taken by the G20, but also for unrelated reasons. It turned out that Africa was one of the most resilient regions during the depth of the crisis. 3 reasons have been put forward for this. Firstly, African exports were increasingly going to Asia. China and India continued to grow during this period, helping Africa along. Secondly, as many African countries had just gone through a debt relief program where their debt obligations were reduced if they adopted responsible macroeconomic policies. Not only were their debt levels lower, but their policies were considerably better. Better than before and better than many so-called developed countries. Africa's current growth rate is about 4.8%. This includes South Africa, which is the largest economy in Africa, and was more severely hit by the financial crisis than many other African countries. If we look at Africa's growth rate today without South Africa, growth is not 4.8%, but is standing at 6%. It is clear that Africa's current growth performance is consistently stronger than at any other time of our modern economic history. Against this background, we have to ask questions. Do we know why Africa's growth is strong? Do we know how long it will continue? Do we also know what we need to do to ensure that it does continue in a sustainable way? Program Director, the most obvious reason for the recent growth of Africa since the mid-1990s is the rising demand for Africa's products. Africa is one of the world's great producers of raw materials, from oil, coal, iron ore, copper, and diamonds, cotton, sugar, coffee, and beef. With the East Asian fast growth, with their huge infrastructure investments, especially in China, and with the rising consumer capacity of their growing middle class, demand was rising for exactly the kind of products markets that Africa competes with. The last time the world saw a concerted rise in infrastructure and consumer demand was in the so-called golden era of capitalism in the 1950s and the 1960s, when investment and consumption in Europe and North America grew so fast. In the 1970s and the 1980s, commodity prices were low as global investment and consumption slowed down. So clearly, the boom in investment and consumption in East and South Asia contributed to Africa's improved performance since the mid to 1990s. A second embedded factor was the debt relief program of the early 2000s. The heavily indebted Poor Countries Initiative and the Multilateral Debt Relief Initiative allowed African countries to reduce their debt levels. HIPC was launched in 1996 by the World Bank and the IMF, and the MDRI was added in 2005. At that point, $80 billion of debt relief was available to all countries by 2006. Actually, this is not such a large sum by US and Chinese standards. But for the small African countries, debt obligations of even $2 billion was crippling. With even those relatively small debts, export revenues were instantly repatriated as payment for the interest on the debt. To end debt relief status, African countries had to follow a path of macroeconomic discipline. Unlike the conditionalities of the early 1990s, the so-called Washington Consensus, the conditions did not include interfering in the wide range of domestic economic policy. It simply meant that government must not spend more than they can afford to, and that they should try to ensure that essentials are first in line, and that the needs of the poor are addressed. By 2012, 34 African countries had passed the completion point of the debt relief. The impact was considerable in improving the balance sheets of governments and introducing responsible macroeconomic policies where necessary. Low debt and better policies certainly helped Africa through the crisis. A third and important factor is better and improving governance in Africa. Since the end of the Cold War, there has been a powerful trend in Africa towards democratization and greater accountability. South Africa and Namibia were two obvious beneficiaries, but many other countries in Africa have established much stronger and more accountable governance system. By one measure, the Freedom House measure, the percentage of African countries classified as free or almost free has grown from less than a quarter in 1990 to more than three quarters in the present day. Danny Roderick, Harvard professor and one of the world's finest development economists, argues that very cogently that democracies and better governed societies are more able to ride through the external economic shocks than authoritarian countries or dictatorships. So the shift to better governance in Africa was also one of the contributing factors to ensuring that the global financial crisis did not have extensive and excessive negative impacts in the continent. But we know that the patterns of growth in Africa are far from perfect. If we think about making African growth sustainable for a long haul, what are the key deficiencies that need to be addressed? It's no secret that Africa's output is not very diverse. We tend to produce narrow range of raw materials for exports and some staple foods for domestic consumption. In most African countries, manufacturing is weak, the service sector is underdeveloped, and there is relatively little production of high-value agricultural crops for export. Also, markets for tourism tends to be very poorly developed. So the scope for diversification of production and exports is quite large. African countries might focus on different assets. For example, the highly populated countries of East Africa, namely Ethiopia, Kenya, and Tanzania, might well find a way into labor-intensive manufacturing. Land-rich countries like Angola, Zambia, Mozambique have huge opportunities for commercial agriculture. North African countries could exploit their tourist potential for Europe far more effectively. These are just a few examples. Africa must diversify. This is critically important for the sustainability of the current growth trajectory. A second factor is regional integration. African countries don't trade enough amongst each other. In fact, one of my colleagues in the neighboring countries, when we're discussing some of our common interests, he puts it this way, that Africa is the supermarket of South Africa. So if you focus to sell your products in Africa, you must know that the supermarket is there. This is a huge challenge. While we talk about the need to trade, we allow our special interests to erect barriers against other African countries and end up importing from Asia or Europe. The tripartite integration initiatives seeks to unite 26 African countries from South Africa to Egypt into one free trade area by June 2014. This was decided in a meeting in Johannesburg a year ago. This is a hugely important project. We are obligated to achieve this objective. Our people should hold us accountable if we do not achieve this objective. Another factor where most African countries have not been very successful is in ensuring that the fruits of growth are well distributed. There are several important ways to ensure economic inclusion. One is through investment in social infrastructure, investing in better human settlements, which is one of the most important redistributive interventions that governments can make. Many African countries with rising urban populations are not really getting to grips with social infrastructure investment yet. Just as important are social services. The Millennium Development Goals targeted levels of access to schooling. Numbers in school in many African countries have risen very well. But the quality of education in some African countries, including South Africa, remain one of the most important unanswered redistributive questions. If we make quality education available to all, nothing else is as important as a basis for inclusive growth. Finally, and just as important, How do we broaden the opportunities for getting directly involved in the economy? How do we create an environment for small business development in Africa? Not the subsistence sector, but real growing small and medium businesses. How do we create labor markets that encourage higher levels of employment? And these targets are critical for us to deal with. Africa's growth will be sustainable if we can achieve the following objectives. Firstly, thus diversify production and exports. Secondly, drive regional economic integration. And thirdly, ensure that the growth is really inclusive through better social infrastructure, better quality of social services, and through the wider availability of economic opportunities and increasing our level of education and skills. In conclusion, we need to answer these fundamental questions. How do we lay the foundations for Africa's long-term financial and economic health? As a continent, we need to strengthen leadership in Africa, from political leaders to senior officials in all spheres of government, and we do this across Africa. We can truly make this African continent a success. I thank you.